It's 11:47 p.m. on a Sunday. You're lying in bed with your phone tilted toward your face, doing something you've been circling for 6 months. Reading about rental properties. Not reading seriously. Reading in that half-committed way where you open 4 tabs, skim 3 of them, and close all 4 without saving a single thing. You've got $22,000 sitting in a savings account earning 4.6% interest. That's not nothing, but it doesn't feel like anything either. It feels like permission to keep waiting. And somewhere in the back of your head, there's a number you keep almost doing the math on. Something about passive income. Something about making your money work for you. You've heard it 100 times. You've never seen it broken down in a way that actually made sense for where you are right now. That's what tonight is. My name is Elena, and I spend a genuinely alarming amount of time thinking about why the same real estate market produces landlords who retire early and landlords who quietly sell off at a loss and never talk about it again. If you've ever stared at your savings and wondered whether rental property is actually the thing, or just something people say, subscribe and hit that like button because that is exactly what this video is going to answer. Before we get into it, not a financial advisor, none of this is financial advice. This is math and pattern recognition. What you do with it is your call. What we're going to do tonight is walk your life through every level of rental portfolio, not the fantasy version, the real one, where the traps are, where the exhale happens, and where, if you're not careful, a good decision turns into a very expensive education. Let's start with the person who gets into real estate without quite deciding to. You're 31. You got a job offer 2 states away. You bought your first place 3 years ago for $265,000, put 5% down, and you still owe $247,000 on it. The market moved in your favor. You could sell and walk away with maybe $38,000 after fees. Or you could rent it out. Your mortgage payment is $1,640. Comparable rentals in your neighborhood are going for $1,900. That's $260 a month positive. Someone in the comments right now is already doing the math. Don't. Here's what most people at level 1 don't realize. The trap here is the math that only includes the mortgage. You have not yet priced in property management at 8 to 10% of rent, which takes you to $1,710, $1,830. You have not priced in vacancy. A single month vacant wipes out 5 months of cash flow. You have not priced in the water heater that will die in year 2, which costs $1,200, $1,800 installed. You have not priced in the tenant who pays 11 days late every single month, which is technically not a lease violation in most states. What looks like $260 a month often nets to somewhere between negative $40 and positive $80 when you run the actual math. That's not a rental property. That's a second job with unlimited liability and no guaranteed hours. This doesn't mean don't do it. This means know what you're actually buying. The exit from level 1 is one thing. Before you rent it out, run the full expense model. Mortgage plus taxes plus insurance plus vacancy buffer plus maintenance plus management. If that number leaves positive cash flow after all of it, you have a property. If it doesn't, you have a problem disguised as an opportunity. And here's the emotional layer nobody warns you about. When the math comes back negative, when you run every number honestly and the spreadsheet tells you this doesn't work, the psychological pressure to rationalize it anyway is enormous. You already have the property. You already told 3 people about your plan. The sunk cost of the decision makes the actual cost invisible. That rationalization is where level 1 landlords turn a borderline deal into a 5-year drain. Dalbar's 2022 Investor Behavior Report found that individual investors consistently underperform the very assets they hold. Not because the assets are bad, but because the emotional decisions surrounding those assets are expensive. Real estate is not exempt from this. The investors who build wealth with rentals are not the ones with the best properties. They are the ones who ran the math before their feelings were already attached to the outcome. Sit with that. 2 people start here at the same time. We'll call them Jada and Kevin, both 31, both with a condo they're moving out of, both looking at the same rental market. The only difference is what they do with that spreadsheet. Level 2 is where it starts feeling real. You have equity, a little cash, and for the first time in your life, you're thinking about a property you actually meant to buy as a rental from day one. You're 35, you've been saving, you've got $60,000 liquid. You find a duplex for $310,000. You put 20% down, $62,000, and you're in. Unit A rents for $1,400. Unit B, where you're living, saves you $1,350 a month in rent you'd otherwise be paying somewhere else. Your mortgage is $1,910. On paper, this is the house hack. It's real, it works. But here is where the trap lives. The trap at level 2 is the illusion of two incomes. You're counting Unit A's rent as income and your own housing savings as income. But what you've actually done is purchase a $310,000 asset on a single income foundation. If Unit A sits vacant for 2 months, and it will, eventually, you are personally responsible for $1,980 a month on what was supposed to be nearly free housing. A study from the Federal Reserve found that 40% of small landlords reported a period of financial stress within their first 3 years of ownership that they hadn't anticipated. That number isn't 40% of bad landlords. That's 40% of all landlords. Sit with that. The exit at level 2 is reserves, not just a down payment and a good feeling. Before you close, you need 6 months of the full mortgage in a separate account that you do not touch. If that account doesn't exist, you don't have a rental property yet. You have a bet. There is no shame in taking 6 more months to build that reserve before buying. There is significant shame and significant financial damage in owning a property you can't weather. The bank approved your mortgage. The bank does not care what happens when your tenant moves out in month 8. That is exclusively your problem. Jada builds the reserve before she buys. Kevin buys first and tells himself he'll build it after. By month 7, Kevin's Unit A is between tenants, and his reserve account is at $2,100. Here's where I need you to stay with me, because the second half of this video is where the math starts doing something genuinely strange. Level 3 is the most dangerous level on this entire list. Not because the properties are bad, because you've had enough success that the psychological guardrails come down. You're 39. You have 2 properties. One is solidly cash flowing at $340 a month after everything. The other breaks even most months and earns its keep and appreciation. Your total real estate equity is around $200,000. You feel like you've figured something out. You start looking at a third property. You talk to a lender. You can qualify. And here's the phrase that ends careers before they should end. I've done this before. The trap at level 3 is operational complexity that increases faster than income. 1 property is a hobby, 2 is a system, 3 is a business. And you do not yet have a business. You have a job that doesn't pay you hourly. Here's what the math looks like. Each property needs its own reserve account, its own insurance review, its own lease tracking, its own maintenance relationship, its own tax treatment. 2 properties is manageable solo. 3 or more without systems doesn't triple your work. Research from BiggerPockets' 2023 Landlord Survey found that landlords who went from 2 to 3 properties without documented systems spent an average of 11 additional hours per month on administration alone, not repairs, not tenant management, just paperwork and tracking. That is not passive income. That is a part-time job with a variable schedule and no HR department. Here's what happens when the systems don't exist. Property 3 has a roof issue. Property 1's tenant texts you about a broken furnace. Property 2's lease is up in 14 days and you haven't sent the renewal notice. All 3 things happen in the same week, because that's how life works, and you are now triaging 3 simultaneous problems across 3 different addresses, all of which have legal and financial implications if you handle them wrong. The stress doesn't triple, it compounds. The exit at level 3 is the decision you make before you sign on a third property. Hire a property manager or build a real system. Not later. Before, Jada hires a property manager for all 3 at 9%, decides to treat it as a real portfolio cost, and her math still works. Kevin self-manages all three and starts missing lease renewals. Level 4 is where landlording becomes investing. The vocabulary changes. You stop saying my rental and start saying my portfolio. You start tracking cash-on-cash return, not just monthly cash flow. You have an accountant who specializes in real estate. You're 44, 4 to 6 properties. Net real estate equity somewhere between $400,000 and $1 million. You're generating $2,800, $4,500 a month in actual cash flow after management, reserves, and taxes. That number is real. That number changes things. But here's the trap most people never see coming at level 4. The trap is concentration risk wearing the mask of diversification. You own 4 properties. They feel like 4 different assets. But if they're all single-family homes in the same metro area, and for most landlords at this level, they are, you don't have a diversified portfolio. You have 4 highly correlated bets on one local economy. When the auto plant lays off 2,000 workers, your 4 properties don't just get harder to rent. They all get harder to rent simultaneously in the same market at the same time. That's not 4 problems. That's one problem that happens to have 4 addresses. Real diversification at level 4 means different property types, different neighborhoods with different economic drivers, or different geographies. It means a duplex in a college town behaves differently from a single-family home in a commuter suburb. It means your portfolio can absorb a localized shock without your entire net worth absorbing it simultaneously. The other thing that shows up at level 4, and nobody talks about, is the tax structure conversation you should have been having since level 2, but almost certainly weren't. At $400,000, $1 million in equity, you're almost certainly operating as a sole proprietor or under one LLC you formed because someone on a forum told you to. You may have significant depreciation recapture exposure you haven't modeled. You may be missing cost segregation benefits that would meaningfully change your tax picture. This is the level where a CPA who specializes in real estate, not just a generalist who does real estate clients, pays for themselves many times over. The exit at level 4 is intentional geography. Before buying property, 5, ask yourself, if this city's largest employer announced layoffs tomorrow, how many of my units would be affected? If the answer is more than 1, you're not diversified yet. Jada's 4th property is a small multifamily in a city 90 minutes from her other holdings, near a teaching hospital. Kevin's 4th property is 3 blocks from his first 3. Level 5 is where the psychological shift happens that separates landlords from real estate operators. You're 49. Your portfolio is worth somewhere between $1.5 million and $3 million on paper. Your equity is above $1 million. You're cash flowing $5,000, $9,000 a month after everything. And for the first time in your life, you realize something genuinely strange. The money has stopped being the point. That sounds like a good problem. It is not. It is the most insidious trap on this entire list. The trap at level 5 is that the money has been replaced by the identity. You are now a real estate person. You think about it at dinner. You follow the forums. You underwrite deals on vacation. And the risk is that you start acquiring properties to stay in the game, to feel like you're doing something, rather than because the math works. There's a Stanford behavioral finance study that found high net worth individuals with concentrated asset classes, which is every serious real estate investor, showed significantly higher rates of what researchers called activity bias, a tendency to act to feel in control rather than because action is the optimal move. Real estate investors are particularly susceptible because, unlike stock portfolios, every acquisition feels like a concrete, intentional decision. Activity for its own sake at level 5 means buying a 6th property with thin margins just to keep growing, taking on debt that reduces your portfolio's resilience, and ignoring the option that nobody talks about at this level: consolidating, selling the weakest assets, and making the remaining portfolio significantly more durable. The exit at level 5 is the quarterly review you do not currently do. Every 90 days, which property has the worst cash-on-cash return? Why? Is it fixable? Or is it worth more sold than held? The operator knows that a clean portfolio of 4 strong assets outperforms a stretched portfolio of 8 mediocre ones. Jada sells her weakest property at 51 and uses the proceeds to pay down the mortgage on her highest performing one. Kevin buys property 7. Kevin's monthly cash flow is higher. Kevin's margin for error is near zero. I want to introduce you to a real person. Her name is Doris. Not famous. Retired school teacher from Ohio. When she died in 2018, her estate included 7 rental properties she'd purchased between 1971 and 1994, all within a 40-mile radius of her home. She'd never hired a real estate attorney. She'd never read an investment book. She managed her properties herself until her late 70s. Her estate was worth $2.6 million. She had bought boring properties in boring neighborhoods and held them for decades without any of the optimization we've been discussing. She never reached level 6 by any technical definition, but she died wealthy because she did 4 things. She never sold when the market scared her. She never over-leveraged to grow faster. She kept her expenses lower than her income for 40 years, and she reinvested instead of spending. At level 6, the trap is the one that ends the story before you get to Doris. The trap is tax-driven decision-making that prioritizes complexity over clarity. At $3 million in equity and above, the structures people build, LLCs, 1031 exchanges, opportunity zone investments, cost segregation studies, are all legitimate. They are also all reasons to keep acquiring, keep deferring, keep building something that requires a specialist to maintain, and never stop to ask, is this actually making my life better? A 1031 exchange defers capital gains tax but requires you to identify a replacement property within 45 days and close within 180 days. That timeline creates urgency that is not financially motivated. It is tax motivated. And urgency without financial motivation is how otherwise sophisticated investors buy mediocre properties. The exit at level 6 is the question that nobody in real estate is incentivized to ask you. What would your life look like if you stopped acquiring? Not if you sold everything. Just, if the portfolio you have right now is the portfolio you keep, is it enough? For most people at this level, the answer is yes. But the industry doesn't get paid when you say yes to enough. Here is the thing nobody shows you about rental portfolios. The gap between Jada and Kevin didn't open at level 5 when Kevin bought his 7th property. It didn't open at level 3 when he skipped the property manager. It opened in 100 small, boring, completely unsexy decisions across 15 years. It opened the night Kevin looked at $260 a month positive cash flow and didn't do the rest of the math. It opened when he used his first deal's success as permission to skip the reserves conversation on his second. It opened when he added a 4th address in the same zip code as his first 3. None of those decisions looked wrong in the moment. They each made intuitive sense. That's what makes them traps. What Jada built, and what Kevin, if he's honest with himself, is realizing he didn't build, is not a bigger portfolio. It's a more resilient one. The difference between a portfolio that produces wealth and a portfolio that produces stress is not the number of properties, it's the margin. Margin in the cash flow, margin in the reserves, margin in the systems, margin in the geography. Margin is what lets you survive the things you didn't model for, and real estate will always produce at least one thing you didn't model for. Charlie Munger said it better than I can. I have nothing to add to my earlier statement. He said that after a Berkshire meeting where a complex question got a simple answer, the simple answer in real estate is this: run the whole math, build the reserves, don't concentrate, don't over-leverage, hire help before you need it, and stay in long enough for the compounding to do its job. That's it. That's the whole system. Real estate wealth, the kind that holds, the kind that compounds, the kind that gives you options in your 50s instead of obligations, doesn't come from being smart about properties. It comes from being honest about systems, disciplined about reserves, and humble enough to run the full math even when the short version looks good. The boring choice is not the consolation prize. It is the strategy. That's what Jada discovers at 54. That's what every person who actually gets there reports. Not that they had more money, though the money takes care of itself, but that they can finally make decisions based on what they actually want rather than what the portfolio requires. They wake up on a Tuesday and realize that the thing they built is working without them, quietly, predictably in the background, and that is the most underrated feeling in personal finance. The gap didn't open at 54. It opened in 100 small moments across 2 decades. The question you have right now, the one that kept your phone screen lit at 11:47 on a Sunday, is which side of that gap you're going to choose to build toward. Tonight was that decision. And if you found this useful, the like button genuinely helps other people who are lying awake doing the same math you've been doing find this video. So if tonight gave you something, that's how you pass it on. See you next week.